stocks of the day. Couple of favourites of the panel here, or one member of the panel. QBE and IAG, outward news today. QBE has retained its full year guidance, but says higher than expected catastrophe costs estimated to total $1.7 billion of introduced some risks. Meanwhile, IAG is targeting a $400 million raise through the issue of its second capital notes offering. Let's see how the stocks are performing. A bit of a mixed bag there. All right, sure, we'll do them. QBE first up. Mathan, you've been big on the insurers.
Yes. Look, it plays...
Change your mind?
Actually, you have to change when the data changes.
Yep.
We've been positive on the insurance sector for a while.
Yeah.
Both of them have outperformed weak markets. We recently just got out of QBE.
Right.
The risk there is, I think we've reached the peak in the current cycle as far as, I think for me, the US dollar and the bond yields. If it goes any higher, we've got bigger problems to worry about.
Right.
So in that context, you have to be a bit more careful. Is there, I guess, disaster risk coming? That's always there. They reinsure. It's a science project at the best of times. It's going to get even more complicated. Now, I think the bigger risk for me is what's happening in the US dollar. That is a big move, and that tells me people are starting to worry about the recession risk that's coming into the US economy. So that plays into the currency risk, which kind of was my benefit for the QBE, is now turning into a negative. So in that context, you've got to be careful. So we've taken QBE out. We're still in IAG. I still think that's there's not too many turnaround big caps, and that's playing out. Premiums are going to rise, but they'll, it's not easy. But I think this is one where the market finds it hard to play and stays out of it. We've had a bit of a bounce back. I think IAG is not cheap anymore, but we're still pretty comfortable it'll hold up. Now QBE, for me, with what's happening on the global and the currency play, it's become a bit more negative. So we're more neutral on the sector now. And we got
so a hold for IAG, a no for QBE at the moment. Go ahead.
These are the most important words you can understand in finance, and everyone should be taking notes about what I'm about to say. Very important. No effing idea. I don't know. And if anyone's ever had a look at the accounts of those businesses, the sensible answer is always, I don't know. These are black boxes.
Right.
They take in money and they invest them somewhere, you don't know where, at variable returns with a fixed liability.
So you would never be in them? Just because they're too complex.
They are extremely complex. I think when you're buying a stock, there are two things you need to do to make money when you're buying a stock. You need a differentiated view, and you need to be right. Now, an example of that is, I was up here saying Magellan was a brilliant buy about a year ago. I had a differentiated view of that business, but I was wrong, and the stock price got crunched. Opposite is true for coal. Had a differentiated view and was right. And it's gone up a lot. You need both those things to be working in your favor to make money. There's no point being right about something, but it's a consensus view and everyone knows it. It doesn't help you. How do you come up with a differentiated view on QBE or IAG? How do you come up with a thesis? How do you come up with an investment insight? These are incredibly complicated businesses where the variables are hard to understand. They're incredibly well covered, well understood. I think you need to be a subject matter expert. We actually made huge losses in QBE about 10 years ago, and the best analyst on our team covered that stock. He didn't just pick it or guess it or chart it, right? He did real work on it, spent months on this company, delving into everything, built an incredibly detailed model, knew everything about this business, and was completely bamboozled by the news that came subsequent to that. And I've never forgotten that lesson, that smarts can't save you. There are just some things that are too hard. I think there are times when these stocks get very cheap.
That's right.
And there are doubtless times to buy them. I mean, I'll shout out to Math. He's actually done well out of these for a number of years, not just once, but for a time. So I think there is a way to make money, but I don't know how to do it.
I think the valuation, as with anything, like we talk about agriculture stocks or insurance stocks, the risk is high because they're cyclical, there are issues that can come up every so often. So you want the discount when you get in to cater for that. And there was that discount probably around a year ago in the insurance sector because market did not believe the bond yields will go up. And they invest a fair amount into the fixed income, right? So when yields go up, they tend to do quite well. So that exposure played well. Now we get to the other side of the cycle. Now you're trying to bet against something going wrong, and this is a sector where even the great Buffett loses money. So you got to be careful.
I would just caution that I often am a fan of simplicity, and I like simplicity in investing generally. I think here it's easy to be simplistic, and it's easy to be wrong when you're simplistic. Like I hear too many investors get up and say, "Oh, it's an exposure to interest rate cycle, or the insurance cycle is going to turn." Like these are complicated cycles. When you have a whole string of natural disasters, you actually end up with higher insurance prices in the subsequent years. So it's hard to pick that. When you have a long period of low interest rates, the high interest rates then changes the pricing on the insurance book. The two revenue streams of interest rates and insurance pricing, they're interlinked, and trying to unravel them and think you have an insight into one market or the other is really hard.